We're back with another episode of Living in Granbury and Beyond. Today, we're going to take a quick look at the real estate market. We're in the middle of summer. Real estate activity is going through its natural season where buyers are buying, sellers are selling, and a lot of people are trying to get everything done they can in the summer before school starts in mid-August. So there's a last little push from July to mid-August where a lot of people are going to be making their move. A flurry of real estate activity is going to happen. New listings are going to hit the market. People are going to be moving. And in the middle of all this, we're celebrating our 250-year anniversary of becoming a nation this 4th of July. So it's going to be a nice weekend. Hopefully people are out barbecuing with their family, enjoying some time. But we expect the real estate market to continue to have a nice little push of activity as we near the beginning of the next school year. So before you make a move or before you come here and buy a property, you may be wondering, what should I expect? How much will sellers come down on their prices? How long are homes spending on the market before they go under contract? These are all some really good questions that we're going to jump into, and we're going to jump into that right now. Before we get started, if this is your first time to the channel, we really appreciate you tuning in to today's episode. We're glad you found us. We try to cover everything about living here in the Granbury region. North Texas, Weatherford, Glen Rose, Granbury, going out to Toller and Stephenville. We cover all of these areas. We live here in Granbury. We love the Granbury area, and we kind of serve this little 1-hour radius community. So if you have any questions, you want to find out more, feel free to reach out to us, give us a call, text, or email. We'd love to connect with you, answer any questions you have, or give you any advice. All right, so we're looking at a market update, and so I'm going to share my screen with you, and I'm going to show you a few pieces of information that we think are going to be helpful to give you a snapshot of where we're at in the current market. So this is a best-in-class real estate information. Housing Wire, we have to pay to get access to this stuff, but it really is some good information. We will go over a few articles from this site, and you can just rely on us to kind of pass on some of the information. If you're a nerd or a geek and you want to read on real estate stuff, even though you're maybe not in the space as much, it's a great thing, a great one to subscribe to. It's really good information. Today, we're going to cover a few articles from Housing Wire to give you an idea of what's going on in the world and why we're here, while we're having the situation that we are. So beginning of the year, things were looking really good. Rates were at 3-year lows. Market was really picking up, and the conflict in Iran kicked off and basically sent oil up to $111 a barrel. And what we ended up seeing was inflation beginning to rear its ugly head again, and concerns about pricing. And so there's talks of actually potentially 1 to 3 rate hikes this year. Go back to January, we were looking at 3 rate cuts this year. We're in, July, and we're looking at 3 potential rate hikes. I don't think we're going to see 3 rate hikes. It's on the block for discussion. So why did this happen? Well, the oil prices pushed up, price of everything else began to go up, and that caused concerns about inflation. The Fed is trying to get inflation closer to that 2% number. They've had a hard time getting there. We were getting really close in January before this conflict started, and the high oil prices did not help at all. Despite that, the market has been relatively stable. We were seeing explosive growth start to happen around January, February. This conflict caused that to really subside, but we haven't seen the market fall off of a cliff. That hasn't been the case. We've seen steady growth in inventory. We've seen steady purchase applications from buyers that are purchasing. If we look here, pending home sales are a little higher this year than they were last year in 2025, which is kind of, as we are experiencing it, is pretty true. We're having a better year this year at this stage than we were last year. But last year we had a really good end of the year, whereas this year we may not, because the market is beginning to slow a little bit more toward the end of the year, whereas last year rates were on their way down and things were picking up toward the end of the year. If you go look at year-over-year comparisons, pending sales, 2025, there were slightly more pending sales than there are this year, which means we've seen a slight drop in pendings, but they're not substantial. And we're seeing rates between 5.75 and 6.75, and the 10-year Treasury 3.8 to 4.6, which has been the case for a couple of years now. It's been fluctuating between those numbers. Now, if you know what the 10-year Treasury is, essentially it's the thing that drives the mortgage rate. So when we're at 3.8 right now, we're around the 5.75 because that's the spread. There's another article that I've got, and I'm going to go ahead and pull in this article here so you can see it. So this is a Fed annual stress test. It's going to explain something. So the 10-year Treasury yield actually, it went up to like 4% at one point, and the Silicon Valley Bank went through, it actually became insolvent, and there was a run on the banks. And there was a major issue with banks as the market was becoming more volatile. And the spreads for the 10-year Treasury and the mortgage actually got higher. And so even though the 10-year Treasury was only at 4, we were at like 7.8 on interest rates because this mortgage spreads were bad. Well, they've done an annual stress test here, and the banks are able to withstand severe recession models, which means that the spreads are getting a little better. So even though the 10-year Treasury is still high, the mortgage rates are only sitting at 6.5, whereas 2 years ago with the same 10-year Treasury, we were at 7.5, which means there's some things going on behind the scenes that are helping rates stay a little bit lower. In real estate, we call that mortgage spreads. That's the spread. So with that kind of shows why we're at where we're at, despite the fact that we're a little higher on the 10-year Treasury than we were last year. So in recent news, there has been talk of actually a resolution with this Iran conflict. We've seen lots of things come out where they have this memorandum of agreement, and they're going to have a ceasefire. There's been some issues with Israel and Lebanon and Hezbollah, and there's been some fighting going back and forth. I believe they met in Switzerland, and so there's these talks that are happening. And what it's caused is that oil prices have gone from $111 a barrel down to 73, and actually as of today, I believe they were down to $68 a barrel for oil. Those are incredible numbers for oil and should lead to less concerns of inflation. The issue is oil prices dropping that low doesn't necessarily fix the bottleneck of issues that's happened in the Strait for the last 2 months. So it might not be something that just fixes in the snap of a finger. It may take some time for this to work its way through, like a little leaven in the whole lump. It takes a little while for it to work its way into the market and for us to feel the relief of these lower oil prices. Hopefully we don't see the conflict ramp back up and oil prices jump back up to $100 a barrel, because that's just going to exacerbate and elongate this healing process that we need to go through in order to resolve our concerns about inflation. So this article goes through why are rates still really high even though oil prices are low, when it was oil prices that drove the rates up. Well, it wasn't oil prices directly that drove the rates up. It was the impact that oil prices had on the pricing of all commodities that caused inflation concerns. So when oil prices go down, that needs to happen for a long enough period of time where oil refineries and the backlog of everything is refilled, replenished, for the pricing surge that happened from oil. Maybe oil 2 months ago is affecting the cost of chips and goods today. There's going to be a residual effects of those prices for months that are going to take time to resolve before these lower oil prices will show up in the inflation data. So that is something that's really important. I will say too, there's this guy, Housing Wire, has made a comment that when you're looking at the mortgage rates, it really comes down to labor over inflation. So the labor market looks strong, but also there's been a lot of hiring that's been brought in from the World Cup. So one question is, once this World Cup goes, we're going to see a job loss happen because a lot of those jobs are just temporary. When that happens, what is going to be the status, the health of the job market? What is it going to look like? Because if we see the job market really begin to weaken, then we should see the Fed being more concerned about this job issue, and inflation really takes a back seat at that point. So if we see some weakening in the job market, we will see some lower rates more so than what we've expected. And so what does all that mean? We've been geeking out for a little while and wondering what's going on and going into all these details. What does that mean for you if you're looking to purchase a home and move here to the Granbury area? Well, I want to just give you a snapshot of what that means. Right now, homes are taking about 106 days to sell on average in Granbury. What does that mean for you as a buyer? That means that you're getting a lower price, you're able to negotiate concessions, you're able to get more wiggle room from the seller when you're negotiating in the contract and the inspection period. Due to the fact there's more inventory, sellers are having to compete with one another. If there's 12 homes available in your little niche of wherever you're looking, maybe 4 of those are going to sell in the next 4 to 6 months, and 8 of them are going to fail to sell. So if you're going to be one of those 4, the seller has to go above and beyond to try to get you to make a deal with them. And so we're seeing sellers drop prices more, we're seeing more price cuts, we're seeing more negotiation. All of these are things that bode very well for you as a buyer. On the flip side, interest rates are high, homeowners insurance has gone up, and property taxes have gone up in the past 3 years. We've actually seen insurance and taxes come down just a little bit in the last 1.5 to 2 years, which has been a welcome reprieve for us. So we are seeing some benefits, but still in the grand scheme, the high interest rates are causing payments to remain pretty high and elevated. So you're thinking about buying, you're getting a better deal on the house, but the mortgage payments are still pretty high due to these higher interest rates. So that is one con of purchasing right now. In the future, we should see things stabilize at some point. Lord willing, if this war gets worked out, maybe in the nearer future rather than the later future. When that happens, you're going to see prices begin to accelerate and go up a little bit more, but you're going to see mortgage rates go down, which the net impact of that will be lower monthly payments. Even with the prices going up, the lower mortgage rates will cause you to get lower monthly payments, and that will give you some relief on that front. In a perfect world, you'd want to buy a house when the housing market was at its worst, and you can get the best deal on the home. And then when the market improves, you refinance, and then you get the low price, and then you get the low rate on top of it, and you're in great shape. The issue is it's really hard to time that, and nobody really knows when the market's at its worst or when the market's going to start improving. And so people are taking their guesses and they're trying to time the market as best they can. I suspect that the way we've seen the market desire to improve, the way the market was looking earlier this year, as soon as we see rates get closer to that 6% mark, if they go sub 6 for any amount of time, we're going to see the market really start to heat up again. And so when is that going to happen? I think if we can get this Iran conflict solved, we're probably looking at 2027, early 2027, seeing the rates go into the sub 6 market. I think that would be a reasonable expectation. If not, I think the latest would be 2028, but it's hard to say exactly when that will happen. There's no, crystal ball to give you the exact time and measurements. With all of that said, the DFW Metroplex is one of the fastest growing metroplexes in the nation. Granbury is a hot spot. Weatherford obviously is a good location. I-20, there's a lot being developed along those the I-20 corridor going out to Brock, Santo. So what I'm saying is that the market is set to appreciate. So over the next 5 to 10 years, owning real estate is going to be a good commodity to have in this current market. So it's not going to be a risky investment if you do look to make a purchase. It should be something that pays dividends over the next 5 to 10 years. So with that, I hope I've answered a couple of questions, and hopefully I didn't geek out too much on details that make you start to glaze over in the eyes. So, but I like to put one of these out every now and then. I know some people are really focused on the market and trying to figure out when they want to do things. And sometimes, life is what it is, and you can't really make your decisions based on timing of the market. Sometimes, a new baby's coming, or a new job, or someone's passed away, or divorce, or whatever. And so sometimes you just got to do what you got to do, and you got to make the best of the situation that you're in. So if you need any advice, if you want to talk, chat, if there's anything I can help with, I would love to connect with you and visit with you about it. And hopefully you found this information helpful. If I don't hear from you, hopefully I'll see you around Granbury sometime.